Hello, everyone. Dr. Betty has already uploaded answers of tutorial of this tutorial exercise 1. So, do you have any questions about the exercise 1? Or if not, I think I will explain some questions. I think you will meet problems. No question? Okay, I think I will explain the question 1a first. First, you should know some formula for question 1. There are 4 payoff formulas: buy call option, and write call option, and buy put, and write put. Write call option here means sell call option. So the payoff of a buy call option is this means the larger value between 0 and the spot price minus the exercise price. Or you can write like this. And the payoff of a write call option is negative. And buy a put option, the payoff is the bigger value between 0 and exercise price minus the spot price. And the payoff for write put option is negative. So in this question, we write a call and write a put. So for question A, the payoff for write call is and here the exercise price is 105. So the payoff for write call is and we can write it like this. The payoff is 0 when the stock price smaller or equal to 105 and equal to when the stock price is larger than 105. Similarly, we use the payoff formula to write the payoff of the put option. The exercise price of the put is 100. So when the stock price smaller than 100, the payoff is this, and when the stock price larger than 100, the payoff is 0. Because we are calculating the total payoff of the call and put, so we rewrite the payoff of the call option into 3 parts. It's 0 when the stock price smaller or equal to 100, and 0 when the stock price between 100 and 105. So we divided this into 2 parts, and this is the same unchanged. And we rewrite the payoff of the put option into 3 parts. Stock price smaller or equal to 100, and 0 when the stock price between 100 and 105, and 0 when the stock price larger than 100. Here we divided this into 2 parts. Then we can add them together and calculate the total payoff. The total payoff is the payoff of the call option plus the payoff of the put option. So when the stock price smaller or equal to 100, the total payoff is 0 plus this. So and when the stock price between 100 and 105, both payoff are 0. So the total payoff is 0. And when the stock price larger than 105, sorry, it's 105 here. So the total payoff is then based on this formula, we can draw the graph. The vertical is payoff. The horizontal axis is the stock price. It's 100. And 105. When the stock price smaller or equal to 100, the payoff function is this. So it's a straight line. And when the stock price between 100 and 105 is 0, so straight line and 0. And when the stock price larger than 105, it's this. Then the graph is derived. And based on this formula and this graph, we can calculate we can solve the question B, question C, and question D. The answer provided here for question C. Some students are confused how these two numbers come from. The break-even for question C, the break-even point means the gain or loss of the portfolio equal to 0. So the gain or loss is the payoff of the option and the price of the option. If you are seller, we add the price of the option. If you are buyer of the option, we minus the price of the option. So in this question, we are the seller. So the total gain or loss of the portfolio is the payoff plus the price of the option. The payoff is here. And so it is plus the price of the option. The price of the call is 1.75 and the price of the put is 0.75. And here is 0 plus the break-even point means the gain or loss equal to 0. Obviously, when the stock price between 100 and 105, the gain or loss, the gain is 2.5 forever, so we can't realize the break-even point when the stock price between 100 and 105. So we can only realize the break-even point when the stock price smaller than 100 or the stock price larger than 105. Then we can solve the stock price. When the stock price smaller or equal to 100, the gain or loss equal to, we simplify this equation is and let it equal to 0. So the stock price is 97.5. And when the stock price larger than 105, the gain or loss equal to, simplify this equation, is 107.5 minus stock price. That is equal to 0. So the stock price is 107.5. This is for question 1C. Because in your answer, it directly gives you two numbers, so I explain more here. If you have any questions, you can interrupt me. I think the question 2 is quite easy. Just calculate using the put call parity. Then for question 3, first you should know these two numbers are exercise price, and this number is the spot price. So these two numbers are K and this is ST. In question A1, calculate the intrinsic value of in the money September call option. So for September call option, we have two option price. So we have to determine which one we use first. What does in the money mean? In the money means the option we receive the positive return from the option. So this means in the money. So for call option, it means the spot price larger than the exercise price. And for put option, it means the exercise price larger than the spot price. And out of the money means negative return. So for call option, is the spot price smaller than the exercise price, and for put option, is the exercise price smaller than the spot price. So in this question, it's in the money call option because the exercise price, the spot price is 248. For in the money call option, the spot price is 248.7.5. So we have to find a smaller exercise price. So it's 240. Then the price of the September call option is 24.25. So the price of the call option is 24.25. Then we calculate the intrinsic value. Actually, the intrinsic value is the payoff. It's the payoff of the option. So we use the formula at the beginning. I write. We use these four formulas to calculate the intrinsic value of the option. Here it is the 228. The spot price minus the exercise price is, so the intrinsic value of the option is 8.75. For question A2, it asks you to calculate the time value and the in the money and December put option. So similarly, we determine which price of the put we use is in the money. For put, the spot price is 248.75, and the exercise have to be larger than 248. So the exercise price is 260. Then we use this price of the put. So the price of the put here is 24.5, and because the option price equal to intrinsic value plus the time value. So the time value equal to option price minus the intrinsic value. The intrinsic value of the put. So the option price here is 24.5. And the intrinsic value of the put option is the payoff of the put option. The payoff of the put option is 260 minus. So the time value is and for question B, some students don't know how to draw the graph. Similar for the last question, we first write the payoff function. For question B1, we have two choices. The first choice, we only buy the share, only share. So the payoff is the price of the stock minus the price we bought. It is. And the second choice, we not only hold the share, but write one call, write a call. So the payoff has two parts. The payoff of the stock we hold, and the payoff of the right call is the exercise price here is 260. So then we write like this. When the stock price larger than 260, the payoff of the right call is minus. And 0 when smaller than 260. So the total payoff of the share and the call is the payoff of the share plus the payoff of the when the stock price larger than 260 and the stock price smaller than 260. So let's simplify. Oh, sorry, because we write a call, we will receive the price of the option, so we have to plus the price of the call option, which is which is 19.5 here, and plus 19. So it's 30.5 when the stock price larger than 260, and so the total payoff is this. Then we can draw the graph. When the stock price smaller than 260, the payoff is a straight line. When the stock price equal to 229.5, the payoff is 0. So the vertical is payoff, and the horizontal is spot price. So it's a straight line. When the spot price equal to 260, the payoff is 260 minus 229.5 is 35. And when the spot price larger than 260 is 30.5 forever. This is the payoff for choice 2. Because for choice 1, the payoff is this forever, so it's the straight line. And this point is 248.75. So to solve this kind of a question, we can first write the payoff function, and then we draw the graph based on the payoff function. I think this is a more direct way. I think it's better than the answer provided on model. Okay, it's 3:30 now. I will send you Betty's Zoom link. I sent Betty's Zoom link in chat window. Can you see it? Her lecture will start at 3:30, so we have to stop here. See you next week. If you have any other questions, please email me. Bye, thank you. See you next week. Bye.
Hi. Hello, everyone. Oh, by the way, how should I pronounce your name? Yes. How should I pronounce your name, please?
Actually, my name pronounced like Agurim.
Egurim? Okay.
Yes, sounds good.
All right. Okay. Hi, Egurim. If I pronounce your name wrong, but okay, I'll try.
No, that's okay.
Great to see you. All right. Should I wait? How many students?
12.
Is it something like 10 in the previous session, in the GTA lesson session? 12. Okay, then that's probably it. Okay, great. Okay, but at least I get to see one of you. Again, for other people, if you'd like to share yourselves, please feel free. Okay. All right. I think I'll just make a start, right? Okay, so first things first. My understanding is that your exam date has finally been revealed. Okay, and so I think it's December 17th. I think it's a Thursday. Okay, and also I heard that for some of you, you have another exam scheduled the previous day. So on Wednesday, you have another exam. But I heard that it's a 24-hour exam. So you are really under pressure, back to back or something. So there's some room for that. But indeed, it's not ideal. But typically, it was like that in December exam because you have a very small window, like 2-week windows. A lot of things are crammed into that 2-week time. So, well, all I can say is you just need to prepare in advance and also accordingly. You don't want to wait until last week or so. Yeah, you don't really want that. Okay, and also, in this exam, I would say that you need to prepare slightly differently. So for instance, in the past, you're sitting in the exam hall or in a room, and probably you spend, let's just say, example, 10 minutes calculating Black-Scholes put or call option value. You spend 10 minutes by hand, trying to find the numbers from tables or something. This year, you wouldn't want to do that. Okay, you want to get the numbers very, very quickly by perhaps preparing for your own spreadsheet. Okay, and I'm hesitant to say, but I think that I accidentally uploaded my spreadsheet formula. So you can use that spreadsheet formula yourself. I mean, if you put different parameters, I'll talk more about that next week because today we're not going to talk about Black-Scholes, but it's just Black-Scholes, you put different parameters and then you get the call value, put value like instantly. So again, I think that's why we need to change the questions slightly because we thought that you might do that. And so you shouldn't do that. No, what I mean that you shouldn't spend 10 minutes calculating the call value, put value. You really should get that done very, very quickly and then spend the time in other questions. All right, so again, 3 questions, 3 exam questions. The first question, just a reminder, first questions on equity, okay, equity, investing or portfolio management in general, but basically from the first part. And then question 2, 3 from my part. So question number 2 is on bonds. Question number 3 is about derivative securities. Specifically, should be on options. And then we have small questions on global investing or the last unit. So basically what I'm trying to say is everything will be covered. So there's no way around and there's no choice. You just have to answer 3 of them, right? And they're equally weighted. Okay, so 1/3, 1/3, and 1/3. And I think it's fair to say that probably, overall, probably 30%, only 30% of the whole thing will be, calculations. So the remaining part, not necessarily really about the big essay questions, no, but there'll be small questions asking you what do you think, how do you interpret, what does that mean, why why is it not like that? They give you opinions, things like that. Okay, is that clear? Okay, great. And also, just before I start, I would like to say, if you have any questions, by the way, the solutions to tutorial questions and also quizzes have been uploaded on Moodle. So that means that your GTA-less sessions will be more like a Q&A session, discussions and questions. And also, if you have questions on tutorial questions or quizzes, please email them to your GTA. And I'm sure that they will respond rather quickly and they know these questions rather well. And if you have questions on teaching materials, let's just say, forward them to me. I'm happy to meet up with you, have a quick chat, discussing any questions you might have. All right? Okay, great. Any question before we move on to my review? Okay. Like I said, try not to overemphasize it. But it's just that, okay, now we're talking about it. Let me just show what I mean. Okay, but again, it's about next week's tutorials. So yeah, I was thinking to take it out, but I thought probably that's not fair to all of you. So what I meant was teaching slides. This one. So it's really embedded in my teaching slides. Okay. So what I mean is, for instance, the Black-Scholes. Right. These are the sort of elements. Again, you probably don't know it yet if you haven't read or the teaching materials. But just an example, these are the parameters needed for a call. Okay, so this is really some kind of formula behind it, and also delta, and there's a put. And for instance, if the question is becoming like this, you can change the parameters really, really easily, and I'll give you the answer like instantly. And so I think that if I were you, I would prepare spreadsheets like this. And also for bond investing durations, remember there's a sort of a tables, right? So I would prepare spreadsheets like that. And then when I change the parameters, and then you can get a duration in no time. You don't want to spend 5 minutes, 10 minutes calculating duration in this exam. It doesn't make sense. You can, but it doesn't make sense. So I think that at this point, I think that it makes sense. Maybe, in your small group, and you do have a group of people, right? The coursework assignments, the group people. So you can come up with different ways on the spreadsheets. How can we calculate duration in the easiest way, in the quickest way? How can we calculate? I already have this somewhere. So maybe you can come up with an even quicker way or more effective way to calculate calls, puts, delta, this kind of thing, quickly. So that's what we mean by, this year, things are different. And I think that it makes sense for you to prepare the spreadsheet as well. Okay, any other questions? Okay, again, if I would really appreciate if you can give me some response. I know that is one person, so you cannot. But for those who don't want to show themselves, give me a thumbs up, or give me yes, or in the chat box, or give me a shout. I think that, yes, thank you so much. If I see some response, I think that really helps me, just to ensure that you're still there. All right, so let's do this. So this is, excuse me, this final exam limited 2 hours. Yes, it's a timed exam. So meaning that within 24 hours, you can decide to start anytime you want. But once you start, then you have to submit, or your clock stops ticking after, in 2 hours after you started. Okay. Any other questions? Okay, no problem. Happy to answer. Okay, so derivative security analysis, options. And specifically today, this is what's for today. Okay, so again, we start with a sort of a broader discussion or the big picture, and then we will move on to payoff and profit diagrams. And if you look at the past papers, typically there'll be a question asking you to draw stuff, draw diagrams, and I don't see why not this year. So it's very likely that you see similar questions. So just be aware, what are they and what's the difference? If I ask you to draw payoff diagrams, don't give me profit diagram. Okay. So again, I think that also in terms of exam preparation, just ensure that you understand what the question asks. Only answer what's asked. Don't answer, irrelevant things. So, when we mark, again, we don't have a lot of time. We have a time constraint. So when we mark, we're looking for important stuff, relevant key information. So just ensure that you answer the questions asked. Okay. Pucco parity. So this is sort of the first option valuation model. And it is actually a relative valuation model. We'll talk about that later. And more specifically, we'll be more interested in Black-Scholes or the binomial later on, because they give absolute statements about the valuation. Okay. And in the end, we will talk about protective put. And again, there was some kind of diagram you'll see from there. And the suggested rating, so these papers, they're actually more relevant for the next unit, subunit. You can see that is a Black-Scholes, and also related to Black-Scholes. So again, it's all about Black-Scholes. Okay, and we will talk about that next time. But for this unit, you don't need to worry about that. Right? Okay, so some highlights. Again, before getting to the topic, we need to know what are the definition. What's the definition of derivatives? Okay, so basically there, again, is some kind of financial instruments. They are securities whose value is dependent upon the value of something else. Okay, so its value in itself, it doesn't have a value. Its value is attached or derived from something else. That's why we call it derivatives. Okay, so one or more underlying asset, security or variable. And there are two basic types of derivative positions. So the first one is called forward or futures. Okay, and the other one is called options. And yeah, you need to know what they are and what's the main difference between these two. So basically, both refer to some kind of actions that will happen in the future. It's not really about now. Obviously, you buy the contracts now. You pay a price if you need it. But you don't need to transact now. You will be considering whether you want to transact, or it depends on the type. For options, you decide whether you want to exercise my right later on. But for forward and futures, you just have to do it. Whatever, what kind of actions you write in the contracts. Okay. So forward and futures, they have fixed terms and conditions today for transaction at a specified time in the future. And it's a binding contract, meaning that if you enter this contract, you have to transact. Whether it's a gain or it's a loss, you have to transact. For options, it's different. You don't have to transact if you don't want to. Okay, so it's a contract giving its owner the right to buy or sell some kind of transactions, as fixed price on or before a given date. Okay, so again, there's something about this. There's a maturity date for both types. So it's the end date, like bond investing. Okay, and after after that date, the contract will expire, right? Okay, so this really give you some kind of overview. This exhibit illustrates the trading mechanics in a very simple way. So for forward contract, it's really between two counterparties. Okay, and it's individually designed to meet specific needs, so it can be customized. Okay, it's not standardized and it's subject to default risk. And usually there's a sort of intermediary between the both parties, usually a commercial investment bank. And for futures, it's more standardized. It's a little bit like equity investing. So there's a clearing house, right? So ensure that everything runs smoothly. And there's no interaction between the two parts, so you don't get to see each other. And the exchange clearing house oversees delivery and settles daily gains and losses. It's really a regular trading happening there. So, this table illustrates, compares between these two, looking at design flexibility, default risk, and liquidity risk. So we already see the futures. You can see that it's standardized in the clearing house, and for forward, it can be customized. And the default risk is really counterparty. If one party defaults, then it's really the counterparty has to suffer. Okay. And the liquidity risk, it really depends on the trading. There's some trading there. And for forwards, there's no trading, right? And you have to negotiate an exit if one party decides to end the contract. You couldn't just sell it because there's no market for it. You can imagine the contracts, for contract, they are customized. That's good. There's some flexibility. But on the downside is that if you want to sell it, I think the demand will be much less because the contract here is really for your needs. So that doesn't mean that the other people will like it. All right? Still okay with me? Okay, great. What's the meaning? The clearing house? No, it means that it's really the clearing house that needs to bear the risk. Okay, because it's really the clearing house that ensures the trading. So if something goes wrong, it's the clearing house. They need to, bear the subsequent the consequences. It wouldn't be, the other side. But in this case, if something goes wrong, then it's the other party that has to bear the consequences. Is that okay? Okay, great. Very good. Still with me? All right. This is the last session or something. To me, then I don't think I can give you the full points because it's just too simple. All right. So more specifically, the definition of an option is a financial contract that gives the holder the right, but not the obligation to do something. So buy or sell the underlying at a specified price, always a price, okay, in financial instruments within a given period. So already, when you describe an option, these are the elements that you need to specify. So what's the action? Is it buy or sell? What's the underlying? Is it stock or a currency? Whatever. And at a specified price, so what is the exercise price or the strike price? Because that will determine your profit later on. And what's the maturity? So when does the contract expire? Okay, that's also very important here. And why? There are two main reasons why an investor wants to buy or enter the option contract. Obviously, there are sort of small reasons, but what are the two main reasons? What's the main purpose of holding options? Anyone? Give it a try. What are the main reasons? Okay, very good. So risk management. So you're trying to hedge or get some kind of insurance. That's very good. What is the other one? Anyone? Has something to do with your belief. You want to speculate. You have some kind of belief. You believe that the price will go up. Okay, so to take advantage of that, then maybe you can hold a call option. Okay, to take advantage, and that's what we call it a little bit gambling. All right. So let's just assume that I asked you this question in your exam. What's the main reason behind holding an option? And my advice to you is that try to list. Again, I would like to see structure answers. Okay, clearly indicate these are the two important reasons: to hedge risk or to speculate. And then under each key headlines, give me more information. I think that's probably a smarter way, just in case that you don't have time to cover everything. At least you give me something for each point. Okay, so for instance, hedge risk, and then you tell me to reduce risk by holding contract securities whose payoffs are negatively correlated with some kind of risk exposure. And to speculate, when investors use contracts or securities to place a bet on the direction where they believe the market is going to move. Okay, and I would like to draw your attention to this. What's the difference between hedging and insurance? They are not exactly the same. So when I say hedge, I mean that you want the terminal value of your holding to be fixed, regardless of the price movements. So if the price goes up, you still earn this fixed amount of money. When price goes down, you still, earn this amount of money. So that's hedging. Insurance is different. Insurance is trying to protect you from unfavorable price movements. So perhaps there's one direction of the price. Okay, and we'll see that later on, but just be careful. Hedging and insurance, they actually mean different things. Okay. All right, and this table gives you sort of 4 different type position combinations in terms of option trading. So a call option, if you long a call, if you buy a call, if you hold a call, they all mean the same thing. That means that the owner of the call has a right to buy the underlying. And if the call owner decides to buy the underlying and the writer on the other side, the writer has to sell the underlying. Okay, and if the call owner decides not to exercise the right, then what happens? Again, my question is, if the owner of the call option decides to exercise their right to buy the underlying, then the writer or the seller of the option has to meet obligation and has to sell the underlying. That's fine. And what happens if the call owner decides not to exercise the right and just walk away? What happens? Okay, that's good. So that's on the call. Yes. So not really the writer is not losing, but it just said, for the call owner, indeed, they pay the price. So actually they suffer that part. And just said, what I'm asking is really the contract will just expire. Both will walk away. And the benefit for the writer is really the premium received. Okay, they receive a premium and that's pretty much it. Okay, and for the put option, it's the other way around. Okay, and I just said you have the right to sell something, and I think that I would like to remind you, something I think that would be quite useful in terms of option trading. So let me ask you, what's the simplest principle of making money? What's the simplest, in terms of investing, what's the simplest principle of making money?
To buy things in a lower price and to sell it in a higher price.
Yes, love it. Buy low and sell high. I know that sounds very, very silly, but indeed, you have no idea how useful that is, especially when it comes to options, because you need to consider the exercise price and selling price, and sometimes it can be a little bit tricky, especially when it comes to puts. To be honest, I think that even for me, when I was young, I find the concept of put options very, very tricky. So I do feel that you have this, buy low and sell high. Always have this in mind. That really helps you, get to the question very quickly. But again, I think that for me, the simplest principle to make money in terms of investing is buy low and sell high. Okay. And so, in terms of the call option, it gives you the right to buy the underlying at an exercise price. So for you, we really want the exercise price to be as low as possible so that you can sell, at a higher selling price later on. Okay. So that's the idea. Okay. Now, actually, while we're talking about option premium, option price, then let's look a little bit more than or in depth. So the option premium can be decomposed into two components: intrinsic value and speculative value. So what are these two? So the intrinsic value is defined as the difference between the exercise price of the option and the spot price of the underlying asset. So it is as if you exercise it right now. So this is sort of the value or the profit or the payoff you can get if you exercise it right now. If you exercise right now, the difference is really the cash inflow or outflow. Okay, again, if you call option, you will buy at this price and sell at this price. Okay, so the difference is really the value you get as you exercise it right now. And the speculative value is equal to the difference between these two. Okay. And so I think that in intuition, this represents the value or the benefit of waiting. If you don't wait, if you exercise it right now, this is the value you get. So by not exercising right now, you are sort of anticipate to get this value. Okay, so this is what we call time premium, related to the likelihood an underlying assets value will move in the anticipated direction by the contract's maturity. And it really represents the benefit of waiting until expiration. Again, if you don't wait, you exercise it right now, and this is the value you get. So by waiting, you are getting this premium related to time. Okay. And then this is the following thing I'm going to talk about: this at the money, in the money, out of the money. So in a way, it's similar to bonds. So remember, in bonds, we talk about this phrasing. So we said the bond is sold at par. We said the bond is sold at premium. The bond is sold at discount. And this refers to the relationship between the price and par value. Okay, and here, and the money, in the money, out of the money, refer to the relationship between exercise price and current stock price, or more specific, it's about intrinsic value. If the intrinsic value is zero, then we say that the option is at the money. It's like at par, it's an equal thing. And if the intrinsic value is positive, then we say, oh, if you exercise right now, you earn a positive payoff. So it's essentially you got the money. It's in the money. Okay, you got money in the pocket, something like that. And the last scenario is that if the intrinsic value is negative, then we say it's out of money. So for you, you wouldn't want to exercise it. You want to wait. You want to wait and see, hopefully you'll get something very good later on. Okay, still with me? Great, thank you. Rely on one person. If you're nodding, assume that it's all fine. Okay. And then the basic nature of derivative investing. So this illustrates two positions. And so this is a long forward versus long call transaction. Okay. So at origination, for forward, there's no cost. Okay. It sounds very good, right? It sounds like free. Again, in finance, there is no free lunch. You always have to pay later on or something. But in forward, there's no cost. And for a long call, there's premium. So there's some kind of money exchange for a long call. Okay. And fine. So at expiration, and we said there are two potential scenarios. So the first scenario is, when the spot price is higher than exercise price or the contract price for forward. And since you long call and long forward, that means you get to buy the underlying at a lower price, right? Again, buy low and sell high. So for either position, for this, it has to happen. That's fine. But this, you decide to exercise your rights. Again, buy low, sell high. So you'll make this profit. Okay, fine. So in this case, both transactions take place and they earn exactly the same profit or payoff. And then the second scenario or the other scenario is that the spot price is lower than exercise price or contract price. And then for this case, you see that although the price is lower, but you just have to buy. Okay, so that means that then you have to buy high and sell low. So that means you're making a loss. Okay, and for this one, for the call, you just walk away because it's not profitable for you to do this. So in this scenario, actually, the same outcome. And in this scenario, you see different outcomes. Okay, so this is really the takeaway. Both provide the same amount of insurance against the price rising in the future. Okay, so this can help you or guarantee you, when this happens, you guarantee a lower price, right? So you can sort of, you don't have to buy this at higher price. That's fine. And the difference is how to pay for the price insurance. In this case, you pay the premium at time zero. And in this case, although the initial cost is zero, essentially you're paying by potentially much larger amount later on. Okay, so a total difference between forward and options lies in the way the investor must pay to acquire benefits. So these are the benefits, the insurance, price insurance you want to achieve. Okay, so either the certainty of the present premium payment, so it's about this one, that's certain, but usually it's much smaller, or the possibility of a future payment that could potentially be much larger. So this can be much larger if the price goes down big time, then you're really suffering a big loss. And also has something to do with the possibility. So again, this is, when you enter this for sure, but at time zero, you don't know about this. So you have some kind of estimate the likelihood, probability. So at time zero, you need to think about what's the expected loss you might have, and then compare the expected loss to the premium and decide which one is more beneficial for you. Okay? Still with me? Very good. And so I love diagrams. I love graphs. Always, so you'll see probably in your exam, you'll see graphs. For my part, I just love graphs. It's fine. So basic payoff and profit diagram. The main difference between these two is costs. Okay, so for instance, this shows you the payoff position or payoff diagram for a long call, and this is short call. And once you consider the cost, then you shift them vertically. So for a long call, you shift it down because you have to pay for the price. So for instance, this one, you go down to here, right? And this represents the cost or the option premium for this call. Okay, and for the other side, short call, then you have to shift upwards because you will receive the option premiums. Okay. Okay, then I will have a quick question for you. So here, for long forward, short forward, we don't see two diagrams. We only see one diagram. So that means the position diagram and the profit diagram for long forward, short forward, they are the same. Why is that? Anyone? Just let me repeat my question. What? Yes, no initial cost. That's great. Indeed, remember, initial cost for 4 contracts, 0. Okay, and okay, I think that's why I would like. Okay, I would like to say why. You may ask why would this be 0? Again, because you can if you on the long position, you can earn and suffer. Okay, you can loan. So you are not really protected one-sided. So that's why both sides will enter the contract because you can lose, you can earn. Both are equal. When you enter the call option, you are just one-sided. The payoff or the position diagram is one-sided, meaning that you're protected. Downside risk. Where but on the other hand, you can earn the upside benefits. And if this is 0, then there's no the other side who will be willing to enter this position. Okay, so it means that you have to pay to enjoy this protection. Okay, but anyway, this is something else. But I just want to say a little bit more why this is possible to have 0 cost in here, because you can suffer. There's a downside risk for you. Okay, but again, the point is that there's no initial cost, and that's why the position diagram and the profit diagram, they are the same. Okay, you don't need to adjust for the cost. And here you see that this is symmetric, so there's some kind of characteristics here, and also the zero-sum games. So I think that's very typical in finance. Okay, and in here is whatever is gained on one side will be sort of suffer on the other side. And so the long call here. So the long call means that you are protected from the downside risk, and also only in the meantime you can enjoy upside benefits. And this is a put option. So it means that if you long a put, then you are you want the price to go down so that you can enjoy a positive payoff then. And here, what I'm trying to say is that for both long call and short puts, both of them sort of anticipate that the price would go up, or at least they wouldn't go down. Okay, if they go down, they are sort of worse off. Okay, and for short a call and long a put, they both want the price to go up or go down. Go down, but at least it's not going up. Okay, so if the price goes up, they are worse off. Okay, so indeed, I'm trying to say, whatever is some position, what are the views, what are the reasons behind each individual holding? You need to know that. Okay, so this example, I think that this example, we use this example not just in this unit, but also in the next unit, 6.2, you'll see so a lot of different graphs using the same information here. Okay, so this table gives you the price of this stock, $40. And in addition, there are 3 call options, 3 put options with different exercise prices and market prices. And then we can determine intrinsic value and also time premium. I underline this too. And the reason is that, can you tell me what are this? So for instance, call number 2. This option is in the money, at the money, or out of the money. So you can, it depends on intrinsic value, right? Can anyone tell me, call number 2, is it in the money, at the money, or out of the money? Anyone? Or just give me some kind of, very good, money, yes. Because if you exercise it right now, the intrinsic value is 0. Okay, so it means that you buy low, not really buy low, buy 40, sell at 40. Okay, so that is 0, so it's at the money. And so for call number 1, it is in the money. And call number 3 is out of money. And another feature I would like to tell you is that out of money is cheaper. So if you look at the different option strategies using out of money, the main reason is really because they are cheaper. They are cheaper. They're much cheaper. So you can see that 3.24 is much cheaper. And there's a reason for that, because it's out of money. Okay, if it's in the money, it should be more valuable. Okay, so indeed you see that it's 8.07, intrinsic value 5, and there's time premium to that. Okay, and so you can do a similar exercise for put options. So put number 2, again, it's at the money, and you can see that this is out of money and this is in the money. Okay, and so this is sort of the profit diagram, and the way I would do it. Again, you can have a different approach, but I always start with exercise price. So for instance, call number 2, start from 40. Okay, it's an exercise price equal to the market price, 40. And then start from, I know I'm not very precise, I'm sorry for that, but it's a call option. So, so intuition, higher price, higher payoff, and you're protected from downside risk. So this is the position diagram for call number 2. And if you do the profit, then that means you have to take into account the market price or option premium you have to pay. So you have to drop downwards up to minus 5.24. So you drop that. And so that's why you see this. Okay, this might sound a little bit, I wouldn't say silly, but this will come very handy when you have a collection or some kind of option portfolio. If you have a number of options, this might come very handy because you have different prices at different, with different options. So usually I do it is really, I do the payoff or position diagram for the whole portfolio. And then I consider the cost of the whole portfolio and I drop at just once or in one go, okay? And, can you do similar things for put options? And this exhibit shows, compares the stock and option investment returns, okay? So let me just say, so this is a long stock. So assuming that you think about buying a stock now, so this is a purchasing price, 40. And so you're using 40 to calculate your return. And then tomorrow, there are 3 different scenarios: lower price, equal price, higher price. And then you can calculate your return depending on different scenarios. So you can expect your returns to be between minus 25% to 25%, depending how price might change. That's fine. How about if you buy call number 2? Okay, so if you buy call number 2, then this is the price you pay, 5.24. So you use 5.24 to calculate your return. That's fine. And in the next period, if the price drops to 30, then you're not going to exercise your call, right? Although you're making a loss. So that's why you just walk away, and then the contract expires 0. And even if the price remains the same, you're indifferent. You can exercise, you don't have to, but still 0. And when the price is higher than the exercise price, then it makes sense for you to exercise your rights. So this 10 is the profit you make. So you see that by holding options, you magnify the potential returns. So in this case, when the price drops, no matter what, you lose everything. You lose the price you pay for this option. Okay, so it's minus 100%. And in a good scenario, even the same price appreciation, by holding the call, you have 90.8% return compared to the situation where you just long the stock. So the main takeaway is really this: options provide some kind of leverage introduce some leverage into your investment portfolios. So both put and call options magnify, it's really intensify, making the numbers much, making the range bigger, magnifies the possible positive and also negative returns of investing in the underlying security. All right. And another thing I would like to say is that, remember we said that, when you invest in options, you have some idea of how the price will move, right? So you have some, you're anticipating the direction of the subsequent underlying stock price movements. But not just that, not just how the price will change, is it upward or downward, but when that will happen, the timing, okay? I think that this is also very important, the timing of that movement. Why? So for instance, if the price of this stock has stayed at 40 through time t, and then rose to 50 on the following day, even just next day, then if you long a stock, if you don't sell it, you can enjoy this 25% gain, that's fine. But if you hold if you own the call option, then because the price appreciation occurs after the option expires, then actually you just earn nothing. Okay, so by holding this call, you actually have some idea that the price appreciation will happen on maturity or before the maturity. It shouldn't be after the maturity. So it has something to do with the timing. Is that right? Okay, great. And then this is really until the up to the end. I thought I could finish it in 30 minutes. But that's fine. As long as that helps, that's fine. But again, I really don't want to, spend so much time in this. Okay, put call parity. So again, it's coming up with by construction. Behind this formula, if you like, is really coming up this hypothetical strategy or investment strategy that gives you a fixed payoff in the next on maturity or in the next period. So how does that work? The strategy consists of a long stock, a long put, and a short call. Okay. And so the net investment or the cost required to acquire this portfolio is this. So this is the cost of this investment strategy. And as you can see from this, depending on the future, 2 different scenarios, you realize that actually this will give you the same payoff or net position regardless of price movements. So it should be a net position. Okay, there's a typo. But anyway, so the result is a risk-free investment, meaning that there's no uncertainty about the net position of this strategy in the next period. So we can do this. So that means the cost is equal to the present value of X. Okay, so that's the idea behind this put-call parity. And so also, why do we say that it's a sort of relative statement? Because, for instance, this call value depends on S, P, and X, or R or T. It's not an absolute statement. Okay, so is this different? Then the call will be different, something like that. So it's really a relative statement. And next thing I would like to do is to move this to the left. And that gives us this. Okay, and this is a combination of long stock and long put. Okay, and the combination of these two is called put protected stock portfolio, or protected put, if you like, for this put option. And so this is really suppose the manager purchases 3 months at the money put option on the $100 million stock portfolio for an upfront premium. So this is the cost for you. So this is really so the position diagram for long stock. And just remember, I would like to some people saying, what's the difference between this and this? Should I draw this or should I draw this? So again, the main difference between these two is about the cost. If you don't have this position and you want to buy this position now, then it will become like this because you have to pay for the cost. And this is the situation where you already have this stock position. Or you can think of this way, assuming that you already buy this for a long time, you already forget about, or this is given by someone else, you don't really know the cost, then for you it becomes like this. Okay, so just be aware what the question asks. If the question say, if you consider buying a stock, that means you haven't had it yet, then it should be around this. It would be much lower. You need to consider the cost. Okay. And for the long put, again, the payoff diagram or the position diagram should be like this, okay? I know I'm not very precise, but it should be like that. But if you consider the cost, you have to drop this. So that's why it's no longer 100, but 98.676, because you have to pay this amount as a premium. But the combination of these two will give you this. So you're protected, your position is protected from downside risk. So if the price drops, you're capped. So your position is capped. But in the meantime, you can enjoy upside benefit. Okay, so this is why we call it put protected stock portfolio. And this can be achieved by holding a call and a risk-free investment worth X in the next period. Okay, so the last thing I would like to say, since we say both are equal, so which one should you choose? The choice between them will come down to considerations such as relative option prices and transaction cost. And without these considerations, you are indifferent between these two because both will give you the same position or payoff or profit position later on. Okay. And the last thing I would like to say, before I let you go, is really very quickly about alternative way to pay for a protected put. Remember, this is a protected put, right? So to protect against the potential stock price declines, we can use short forward contracts or protected puts. And there's a third way or a third alternative, which is simultaneous purchase of an out-of-money put and sell out-of-money call. Remember, out-of-money options are cheaper. But by buying something and selling something at the same time, actually you can ensure that this is free. Actually, from the example, you'll see that it is actually free. So like the forward contract hedge, there's no initial out-of-pocket expense. It's really free by doing this. But it's not really free because although you can protect yourself from downside risk, in the meantime, your upside benefit is capped if you're using collar agreement. It's free, but you're losing this upside benefit if the price goes very high. And although, again, back into here, the put, protected put, although there's a cost attached to it, but you can enjoy the upside benefits in here. So there's always trade-off between the cost and the benefits. And so you need to be aware of that. But again, the main takeaway is that collar agreement can protect you from downside risk and is free. And there's no initial cost. I shouldn't say free. There's no initial cost, but you need to give up upside potential if the price goes significantly higher. Okay, is that right? Is it clear? Still with me? Great, thank you. All right, so I think that's all I wanted to say for this. Let me stop sharing. All right, I know it's quite good. Oh, I'm still using more time than expected. So any questions? Yeah, thank you. Excuse me, there's also put parity. Okay, so what's the difference? Everyone, what do you think? What's the difference? Can you see the chat? I think you can see the chat. So someone asked, there's also put parity in unit 6.2, S plus P equals to C plus E exponential times this. So what's the main difference? Anyone? If you look at here, the put parity. Let me get rid of this. Oh, it's in, wait a second. So let me share again mine very quickly. I think that's a very good question. So what do you think? What's the main difference? I know this looks a little bit scary, but okay, let me discard. We can get this parity. Where is it? Okay, here. What's the main difference if I use e to the power minus RT? Are they different? They don't look the same, yes. But they are not exactly different. It just it has something to do with assumption behind, how you consider how time goes. So in this case, you assume that the time is a discrete. It's a period 1, 2, 3, 4, 5. It's a discrete time. And if you use the exponential thing, that means you consider time to go continuously. So you can use both. And it really depends. For the black shoals, you use this exponential because you assume that time moves continuously. And you can also use this if you assume that time goes discretely, 1, 2, 3, and 4, and 5. So my answer is that they are very similar. They are just different ways, of consider time. So then you can use both. Does that help? Is that all right? Okay, good. Any other question before I let you go? I know it's getting late. Stop sharing. Any other things? Okay, helps a lot. Great. All right. Any other questions? Any other burning questions? No? Okay. Wait a second. Okay, let me double. Okay, fine. You're fine. So if no further question, then I think I'll stop here. And so I'm going to I'll see you on Friday. And if not, I'll see you next week. All right. So take care, everybody. Thank you very much. See you later. See ya.